I will start with the introduction. The company we choose is KPJ Healthcare Berhad. It was established in 1992 and based at Johor Bahru, Malaysia. Their main activities is health and personal care stores. The principal activities of the company are investing holding and provision of management service to subsidiaries. KPJ used the Companies Act 2016 to prepare the financial statement for each financial year. It is compliant to Malaysian Financial Reporting Standard (MFRS), International Financial Reporting Standard (IFRS), and the requirement of the Companies Act in Malaysia.
There are several types of plant, property and equipment of KPJ Healthcare Berhad, which is building, renovation, medical and other equipment, furniture and fittings, vehicles, freehold land and computer. The classification of those assets are non-current assets. Non-current assets are long-term investment in a company that have a useful life of more than 1 year. Non-current assets are difficult to convert to cash, and they are required for a company's long-term needs and include things like land and heavy equipment. Assets are reported on the balance sheet on the left side or at the top, depending on the format. The liabilities and owner's equities are then listed on the right or immediately after the assets.
Based on our group's finding in KPJ Healthcare Annual Report, we have found a few information of useful for their property, plant and equipment which known as PPE. There are 28 buildings with more than 3,000 licensed beds. Currently, renovation is underway and they consider adding more beds. Other PPE of their company included medical equipment, furniture and fittings, vehicles, freehold land and computers. As for the depreciation method, freehold land is not depreciated as it has an infinite life. Other PPE are depreciated on the straight line method to allocate the cost or the revenue amounts to their residual value over their estimated useful life.
The method adopted for subsequent measurement of PPE for KPJ Healthcare Berhad is a revaluation model. Property, plant and equipment are generally stated at cost. Land and building are subsequently stated at fair value less subsequent depreciation and impairment loss. The reason the company used the revaluation model is that fixed assets are represented at their current or realizable value. Since the revaluation model, which revalues an asset in accordance with its market value, would be the better option for this business to use the revaluation model because KPJ has assets whose market value fluctuates often. Consider land and other properties as an example. Over time, the price of land has been rising rapidly. This value increase can be captured by the revaluation model. It allows for a better alignment of expenses and revenue and offer a more precise estimation of an asset value. This strategy is simpler for businesses to apply than other methods. So next, I will explain about the net profit ratio. Net profit ratio is the ratio of net profit to total sales or company revenue for a certain period, and it will be stated as a percentage. This ratio is to show how much profit the company produces for every RM1 ringgit made in the company sales. This ratio is also a measure of the company's expenses for each ringgit earned. So, the bigger the company's net profit ratio, the better the company. This ratio represents the performance of a company and we can know if the company is profitable or not. In conclusion, profit for the KPJ Healthcare Berhad is less than satisfactory for 2020 and 2021 and show a negative performance. So now I will explain about operating profit ratio. Operating profit ratio is the amount of money earned by the company from its operation and shows the relationship between the operating profit and the net sales. This ratio is used to measure the efficiency of the company in controlling the costs and the expenses related to business operation. A high operating profit ratio means that operating costs and non-operating costs of the company are low, while the profitability of the company is high. So the higher the ratio, the better the company. In conclusion, in 2020 and 2021 show a negative performance when comparing 2019.
Ratio of liquidity. A liquidity ratio is a type of financial ratio used to determine a company's ability to pay its short-term debt obligation. The first liquidity ratio used is current ratio. Current ratio measures company ability to pay current or short-term liabilities with current or short-term asset. From the data we had analyzed, it is pretty clear that the current ratio for 2019, 2020 and 2021 are all above 1, which is good and acceptable. In 2020, the company had RM2.50 of current asset for each RM1 of its liabilities. So, the current ratio was the most liquid during the year. Likewise, for 2019, the company only had RM1.72 in current asset for each RM1 of its current debt. Other than that, the trend for this ratio is negative, which means further investigation is prudent. The second one is current cash debt leverage ratio. It is a liquidity ratio that assesses an entity's cash management efficiency. The data for 2019, 2020 and 2021 are all above 1.0. A cash debt coverage ratio of less than 1.0 or close to 0 would be a strong indication that the company's financial situation is dire. However, there was a slight increase from 0.04 to 0.14 in 2021. Overall, an alternative has to be taken. The simplest way is to increase net operating income. This can be accomplished by either increasing sales or decreasing expenses. Last but not least is quick ratio. Quick ratio is an accounting ratio that measures the liquidity of a company. From the graph chart, we analyzed that KPJ Healthcare had the same ratio for 2019 and 2020, which is 0.02 times, while in 2021, the quick asset was the lowest with only 0.01 times. We can also see the trend of the graph of 2019 to 2021 are decreasing. As a result, steps should be taken to ensure that the ratio is greater than 1 equal to 1. Since inventory is excluded from quick ratio calculation, selling inventory would result in more cash, which would be included in the quick ratio calculation.
There are two efficiency ratios for this company to measure a company's short-term ability to turn current assets into income. The asset turnover ratio of KPJ Healthcare in 2019 is 0.16, which means every RM1 in assets, the company only generated 0.16 ringgit in sales. For the year 2020, the ratio is decreasing to 0.093, that shows the company earned 0.093 ringgit in sales for every RM1 in assets. The ratio slightly decreased again in the year 2021 for 0.094, which indicates that the company generated 0.094 ringgit in sales for every RM1 of its assets. So, we can conclude that ratio has shown a decreasing trend for the 3 years, and less than 1 means that the company indicates a negative performance and did not manage its assets efficiently. Next, the fixed asset turnover ratio of KPJ Healthcare in 2019 is 0.24. This means the company generates 0.24 ringgit of net sales for every RM1 of fixed assets. The ratio for year 2020 is 0.14, shows that for every RM1 of fixed assets, the company only earned 0.14 ringgit of sales. It shows the decrease in the fixed asset turnover in that year at 0.1. This means the company is not efficient in utilizing its fixed assets to generate sales. However, the company has slightly increased in 2021 by 0.10, which amounts to 0.15. This indicates that the company has generated 0.15 ringgit in sales for every RM1 in fixed assets. So the conclusion is the ratio implies that KPJ Healthcare has not generated adequate sales for its fixed assets investments.
The first type of solvency ratio is the debt to equity ratio. The debt to equity ratio of a company is an indicator of how efficiently it can cover its debt. It is computed by dividing the total debt of a business by the total equity held by the shareholders. Bank and other lenders frequently use the debt to equity ratio to estimate how much debt a company may have. The greater the debt to equity ratio, the more challenging it may be for the company to fulfill all of its liabilities. It also indicates that a company's debt is significantly more than its asset. It implies that the company has RM1.5 in debt for every RM1 in equity. In 2019, KPJ Healthcare Company have a ratio of 0.47. It indicates that in that year, the company had RM0.47 of debt for every RM1 in equity. For both 2020 and 2021, the company has a 0.55 ratio. A ratio of 0.55 means that the company has RM0.55 of debt for every RM1 in equity. Debt to equity ratio in 2020 and 2021 shows an increase of 0.08 from year 2019. This means that it may be difficult for the company to cover its liabilities since the debt of equity ratio is greater than previous year. Next, debt to assets ratio. A debt to assets ratio evaluates a company's overall asset in relation to its debt commitments, including both short and long-term debt. The ratio reveals a company's ability to offer a return on investment. A ratio higher than 1 indicates that a significant share of the assets is financed by debt. When the ratio is less than 0.5, a company's assets are more likely to be financed by equity. In 2020, a total debt to asset ratio is 0.35, that shows 35% of its assets are financed by creditors and the balance are financed by owners' equity. Debt to asset ratio for year 2021 is 0.55. In year 2019 and 2020, the ratio is less than 0.5, shows that the assets are more likely to be financed by equity. Meanwhile, the ratio in year 2021 indicates that the assets are mostly financed by creditors. The last one is the interest coverage ratio. The interest coverage ratio determines a business capacity to pay off accrued interest on borrowings. A high interest coverage ratio suggests that a business can afford its interest costs several times over. The company's financial health improves as value increase. It indicates that regular business activities are generating sufficient revenue to cover interest payments. The interest coverage ratio for KPJ Healthcare Company is 36.3 times. For the year 2020, the ratio is 31 times and 30.7 times in 2021. The interest coverage ratio for the stated 3 years show that KPJ Healthcare income is sufficient for the company to cover interest expense ratio in 2020, show a slight decrease compared to the previous